Hello, I'm Marianne Deveni. One of the biggest complaints from investors right now is the lack of yield in high yield. Are there still opportunities? Well, my next guest says yes. I'm joined by Kocik, Managing Director of TD Asset Management and Portfolio Manager of the TD High Yield Bond Fund. Well, we've heard a lot about what's been going on in the markets. High yield hasn't got so much profile, but there definitely has been a lot of volatility. What's going on, Greg?
Well, high yield has become a bit of a more boring asset class, which is actually something that is not a bad thing for high yield. It's kind of matured as the time has gone on. But basically, what you have seen over the last few years, you had a huge rally over the last 5 years. So the high yield asset class has delivered 11% annual compounded return over the last 5 years. Or if you just look at this year, it's about 7%. We're talking about the US high yield market. If you ignore the currency movements, which actually currency wasn't a big factor. So huge returns, but where are we today? We are sitting at a yield of about 6%. So the question, as you mentioned, is what can you do for me now after these huge returns? And I think that definitely there is still place in your portfolio for high yield. The reason why is because an active manager can find enough deleveraging stories or credit quality improvement stories, which are really essential to making sure that your high yield portfolio performs well. And good news is U.S. economy is doing okay. It's still growing slowly. It's doing okay, which means a number of companies which are in certain sectors like housing or automotive, we can talk about it later, are actually generating better credit quality for investors. So that's a fantastic news for bondholders. You're buying a bond yielding maybe only 6%, which by the way is
not bad.
Not bad. It's like 3 times more than your 10-year government bond. But that 6% can continue to shrink. I mean, meaning we actually will generate capital gains for investors if the company improves its credit quality. So there's definitely still room to go.
So it has a lot more to do then with the credit quality, as you said, with the actual company itself and how well the company is doing. A little bit more like an equity than a traditional bond.
Exactly. Except that in equity, you're thinking about the next 5 to 10 years of earnings improvement. In a high yield bond or any corporate bond, you're worried about company not going bankrupt essentially, which is highly unlikely in most cases. But you're worried about quality of this company, being able to pay coupon on the bonds for the next 3, 4, 5 years. You don't have to think about the next 10, 15 years. So your horizon is much shorter in a corporate bond world. The risk of misjudging a technology turn, for example, in the corporate bond world is much lower than it is in the equity world. All we're worried about is, can this company pay coupon on time over the next several years? Is it strong enough? And right now we continue to find many opportunities of good companies generating those types of returns.
Now you were telling me they're more in the U.S. because in Canada the high yield market is much smaller.
It is very small. Our economy is much smaller than the U.S., so we never had a chance to develop a broad, deep, diversified high yield market. There's a handful of names, so you really have to look outside of Canada for that type of exposure.
So let's talk about a couple of names because you said there were some opportunities out there. What are they?
Well, one sector we like is automotive, and you've got a number of companies that have restructured completely their business models after 08-09 crisis. Not only did they reduce their debt or pension obligations, but they've also rejigged the way, for example, union contracts work in terms of union people being much more flexible to respond to the volatility in that industry. So I think they've been coming together of all the players in the auto industry to create a much more profitable business model, which is fantastic for the workers, by the way, as well as good for everybody else, the providers of capital. So as a buyer of corporate bonds of somebody like, for example, Lear Corporation, which is an automotive parts company in the U.S., what you're looking at over the next 2 years is improving earnings, improving free cash flow. The company already is generating free cash flow, but more importantly, this is a company with almost as much cash today on the balance sheet as it has debt. So the company could actually just, frankly, just repay all its debt if it wanted.
Now, why is that?
Well, they had very strong free cash flows over the last 3 years. They kept it on waiting for maybe capital expenditure opportunity or maybe an acquisition opportunity. The other reason why they kept so much cash is because the ratings were constrained. The quality ratings were quite low given what happened with automotive industry 5 years ago.
Okay.
They're trying to prove to the world, look, we are totally different. We are a lot more, we have a much higher quality right now. Therefore, here's the balance sheet. We've got a lot of cash, and has not been priced into the market. A lot of bonds of these types of companies are still delivering, 5-6% yields, even though the risk of some sort of a negative credit surprise is really quite low.
Now, they have some business in Europe. How is that doing?
Europe has been weak over the last several years, but it's been late into restructuring story. So you had a number of political issues facing those types of companies. They are being resolved right now. Not the same way as the U.S. They will never be as radical as the U.S., but it's moving slowly in the right direction. That's number one. Number two, the sales have been stabilizing in Europe as well. They're not rocketing away. They're not going up in a big way, but they have stabilized. So, today you have a situation where this company is generating strong free cash flow despite significant European exposure. So it's
so that's
really
pretty good
priced in,
that
yes.
they can actually do that, manage
That's
that.
right.
And you also brought me another one in the U.S. wireless sector.
The U.S. wireless sector, a high growth industry. You got 4 players, 2 investment grade. You've got AT&T and Verizon investment grade. Where we are interested in is below investment grade, Sprint and T-Mobile, which is a subsidiary of Deutsche Telekom. So those 2 companies, Sprint, I'll highlight in particular, have had a number of issues 3-4 years ago, and there's still lingering memory in the marketplace about some of the disappointments that they have delivered. They've done okay, but they disappointed investors. So what we see today is they have restructured their operations. They've cut their high cost portion of the network. They are operating in a much more efficient way. And now Sprint has investment grade a shareholder, SoftBank of Japan, which controls 60-70% of the company. So you have a situation where you have a growth story, restructuring story, and you also have the shareholder, which is quite strong. And these bonds are yielding somewhere around 6%.
So you think there's enough behind them then that there's no worry, I guess, from your point of view?
Yeah, I mean, it's a hyper-competitive industry. That's another kind of way of looking at it is, here's a company that for 25 years was dealing with extremely high level of competition. They're dealing with formidable companies like AT&T and Verizon, very, very strong companies with massive market share, great credit ratings, access to capital. And yet, 20 years later, despite this competition, Sprint is still around and is actually improving. So I think they have proven that they can actually operate in that kind of environment.
All right. Thank you very much, Greg. Always interesting to hear about high yield. I've been joined by Greg Kocik, who is Managing Director of TD Asset Management, Portfolio Manager of the TD High Yield Bond Fund. Thanks for watching. Join us again next time. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.